You're watching The Open on BNN Bloomberg. We just got some new data from the Bank of Canada, survey data. They've been talking to businesses, and while there is still a concern for the overall economic picture, Canadian businesses are feeling less concerned about a steep drop-off in growth. Recession fears have been easing. Our next guest is keeping an eye on the growth story for Canada's economy, and his estimates would suggest we are on track for GDP growth in the first quarter to come in higher than what the Bank of Canada is currently projecting. Derek Holt is Vice President and Head of Capital Markets Economics at Scotiabank. Derek, let's start with the survey results from the Bank of Canada today, where people are still concerned, but it seems like there's fewer recessionary concerns. Does that surprise you?
Yeah, I think that's a fair takeaway here, and then there's a little bit more confidence in the numbers. People are a little bit more upbeat upon the outlook going forward on the business side of the picture. However, the catch-22 is that they also think the price pressures might be a little bit more persistent. That's less evident on the business side than it is on the consumer side. Consumers are saying their 1 year ahead inflation expectations sit at 4.9%, the 2 years ahead 3.8%, and what the Bank of Canada I think will find disturbing is that the longer-term consumer expectations measure 5 years out from now, if we all put on our blue sky hats here, is moved up about a half a point to over 3%. So consumers are still signaling that they expect a protracted period of inflation to be riding above the Bank of Canada's 2% inflation target, and we're seeing that trickle into their labor demands in terms of wages and all that. And so that's a bit of a disturbing sign.
And so at the end of the day, for Canadians who are trying to figure out the path ahead on things like interest rates, if you're the Bank of Canada and there are suggestions that businesses think the economy is going to have some resilience, if Canadians are concerned about inflationary pressures sticking around, how does that create a complication for the bank when it comes to actually committing to rate cuts going forward?
I think they have to be super careful. I think they can talk about how they're making progress on some fronts. I mean, we have, in all fairness, I mean, we've come down from the nosebleed territory on inflation of 1, 2, 3 years ago coming out of the pandemic. But I think you'll hear Governor Macklem say that they're not done yet. And we haven't achieved their end goal of 2% on a sustainable basis. And I think what that's going to lead to in next week's April NPR and statement and overall press conference and rate decision is a message of caution that, hey, the economy's improving a little bit into the first quarter. It may be a little bit more resilient than they had anticipated. That's positive news. But at the same time, their mandate is inflation. And so they're not going to be prepared to be guiding interest rate cuts anytime soon, in my opinion.
Okay, well, let's talk a little bit about the growth story for the first quarter and your own projections right now. I realize that when you're trying to figure out the math of the market, if the economy is stronger than what people had previously anticipated, or even what the Bank of Canada had anticipated, maybe that pours a little bit of cold water, to your point, on the pace at which we start to see maybe interest rate cuts. And yet maybe we should be pleased that we're not in a situation where growth is deteriorating as quickly as some might have thought.
It's a great way of putting it. There's a good news, bad news angle to it here, that the economy is more resilient than perhaps the Bank of Canada had expected. Remember, back in the January forecast, the last ones they put out, they expected first quarter economic growth to only be about 0.5% quarter over quarter annualized. And right now, there's a lot of data still to unfold over the rest of the quarter. We don't have any March readings yet, but for the most part, we're still tracking something that could be three-handled in terms of quarter over quarter growth rate. So that would be 6 to 7 times the kind of growth that the Bank of Canada anticipated, with, again, the caveat there's a lot more data to come. And so I'll take that any day. But going forward, I think they also have to take that one step further, John, because I think we just went through a budget season that heaped on additional spending. With the 9 out of 10 provinces that have issued budgets so far, only Manitoba is left this week, and the feds still to release their budget 2 weeks from now, 2 weeks tomorrow. We're tracking fiscal contributions to growth from government spending this year that are probably double what the Bank of Canada had estimated in their January forecast. We're looking at probably something around 1.25%, and it could even move higher yet once we get the federal budget.
Well, there is a story of growth coming from perhaps some government muscle, but what would be your overall message to Ottawa on any spending initiatives going forward?
I would toe the line if it were up to me. I don't think that you need to heap on additional spending. I understand fully the pressures that they are under as politicians to provide goodies to various sectors, and they have a very aggressive social mandate in terms of rolling out core programs that are an expansion of the government's role in the economy. I understand that they have a political goal here, but at the same time, we have to understand that with provinces and the federal government both priming the pump on an ongoing basis, it only delays rate cuts even further.
Okay, a final question for you. One other metric to watch. We do have a jobs report this week. We've often heard people talk about the employment lens as an important one and how the trends look there. I know the numbers get a little bit complicated in Canada just because we've literally had record population growth. But how important is that jobs number going forward to determine where the economy itself is going?
I think each individual jobs report not vary, but if we see a trend emerge that goes in the other direction, say a sudden weakening over a few months, then that would catch the Bank of Canada's attention. And so far, we haven't seen that. So far, as you mentioned, we've had a very strong job market. Over 500,000 jobs created in the Canadian economy since the end of 2022. And many of the wage measures, they're a little bit mixed depending upon which one we look at. But in my reading, they're quite explosive. The latest backward-looking readings, the 4 measures the Bank of Canada tracks, most of them are relatively hot and well above their inflation target. And going forward, the 1/3 of workers who are unionized are getting wage settlements that are going off the charts. And that's cementing years of wage growth out over the 3 to 4 year contract period. And that hasn't even begun to show up in terms of the hard data on wages from the Bank of Canada's 4 lagging measures.